Welcome to TradingPennies.com Chart of the Week, where every week we will examine the trading strategy behind one of our explosive daily stocks picks. All of our strategies are covered in detail in our manual, Learn How Professionals Trade the Penny Stock Market, available on our site at trading-pennies.com. This week's chart is Network Engines Incorporated, ticker symbol NENG, a manufacturer and developer of server-based platforms for IT networks within the technology sector. What drew our attention to Network Engines Incorporated was the developing cup and handle pattern seen on the daily chart. As noted in our manual, proper cup and handle patterns are generally preceded by a prior uptrend of at least 30%. The stock then begins to correct, and the high forms the left side rim of the cup, noted as point A on the chart. As the stock pulls back to form the left side of the cup, it generally does so on greater volatility with increased volume and range between the highs and lows in whatever time frame it forms. As a stock reaches a price range where there is a relative balance between buyers and sellers, it forms the base of the cup. This is noted as point B in the chart. A properly formed base does not violate the lows of the prior trend, and often does not retrace more than 60% of the prior move. A properly formed base will demonstrate a decrease in volatility as it proceeds with a greater number of closes above the prior bar's close on greater volume, in whatever time frame you're viewing. As more buying than selling comes into the stock begins to rise, forming the right side of the cup. The high of the right side of the cup should form slightly below, at, or slightly above the high of the left side of the cup, noted as point C on the chart. The handle is formed when the stock begins to pull back from the high of the right side of the cup. A proper handle should pull back on decreasing volume and demonstrate relatively little volatility. A proper handle forms in the upper half of the cup and should not pull back more than 20% off the handle high. The handle should form above the support of a major moving average in whatever time period you're trading. The buy-in point on a cup and handle pattern is when the high of the handle is broken on significant volume. You will notice on the chart a false breakout, where the handle high was broken on a morning gap up, yet virtually no accompanying volume. You can see this when we look a little closer on the price volume action that took place on the intraday chart. We saw the low volume sell-off of the false breakout, and over the accompanying days the stock once again consolidated along the intraday 200 period moving average. On November 20th, we saw the high of the handle's false breakout broken on significant volume, and where we took our initial position. The stock pulled back to retest the handle high and into the support of the ascending intraday 200 period moving average during afternoon trading. During late day trading, volume came back into the stock and the high of the morning breakout was breached on significant volume, and where we added to our position. As noted in our manual, once in a position, our attentions quickly turn to exit strategies. Professional traders look to find convergence of key pivot points amongst chart patterns not only within a single time frame, but among multiple time frames, as they know that it is here where the greatest number of traders are watching an individual stock, all ready to take or exit a position should their respective key pivot point be breached or turned away on significant volume. Thus, as the stock moves into these key pivot points, we closely watch the price volume action, letting it, not what we project onto the market, dictate our course of trading action. To that end, on the monthly period chart, we saw a key pivot point at the 1.75 price levels, as we saw convergence between a strong price level resistance and the oppressive overhead and descending 50 period moving average. We noted a minor price resistance level at the 1.30, which we noted as a potential pivot point should the general market dynamics be under pressure at such a time as the price level was reached. The weekly period chart demonstrates a convergence amongst the overhead, descending, and significant 200 period moving average and the 1.60 price resistance level. Once again, we saw a minor key pivot point at the 1.30 price level, as it represented a price level resistance. This, though, coupled with a similar price level on the monthly chart, gives it more weight, as we now have convergence between two different time frame charts. The 1.60 price level took on greater strength as a key pivot point in that, in addition to the overhead 200 period moving average and the price level resistance noted previously, we also saw a bull flag consolidation breakout projection pattern target at 1.60 as well. As noted in our manual, a consolidation forms when a stock's price movement trades within a range between two established boundaries after a directional movement in the stock's price, whether that be a previous advance or breakdown. Consolidations take on the appearance of either a pennant, which looks like a triangle, or a flag, which resembles a square or a rectangle, and can form within any time frame. The slope of the triangle or flag can be level or have an upward or downward appearance. As a general rule, downward sloping flags and upward sloping pennants are considered bullish, while upward sloping flags and downward sloping pennants are considered bearish. Flat or level flags and pennants are generally considered bullish or bearish depending on the trend that immediately precedes their formation, and therefore are considered continuation patterns. The development of a pattern over time in which it develops tends to project into the future its target. In the case of a consolidation pattern, if one takes the range between the low and the high of the previous breakout, and then adds that range to the low of the pullback of the consolidation, the high that is projected predicts the next future target and a good place to consider taking profits. Thus, on the weekly chart, the 1.60 price level represents a key pivot point to consider taking action depending on the price volume action at that time. On the daily chart, using a cup and handle consolidation pattern projection target, we saw a potential key pivot point at the 1.70 price level. Using an uptrend line drawn across the lows of the original breakout and pullback on the intraday chart, we drew a channel off the high of the day's breakout trading going into the close at the 1.40 price level. On opening trade, the stock pulled back to the support of the lower border of the uptrend line, as well as the underlying support of the ascending intraday 200 period moving average. Volume quickly came into the stock, and the upper boundary of the up channel was broken, so we quickly drew a similar range up channel projection, and noted the upper boundary to be in the 1.60 to 1.70 price level during morning's trading's time frame. Being the degree of convergence amongst the key pivot points within the various time frame charts, coupled with the degree of extension in price NENG was above the 20 period moving average on the daily chart, and going into the afternoon lulls of trade, we decided to exit our entire position. Another reason was in looking at the daily chart, we saw the makings of the classic volume climax forming. Either way, it was time to get out. To those who maintain position, opening trade on the 24th should have made you suspect. A gap up on trade the day after a high volume range bar, as extended above the support of classic moving averages, is trouble in the making. As can be seen, soon after the open, the stock violently pulled back on heavy volume, breaking the support of the strong intraday uptrend line, as well as the intraday 200 period moving average, which we use as one of our key stop-loss points. As a general rule, we look to the support of the intraday 200 period moving average with a 3-minute time period as our moving stop-loss point, providing the following criteria is met. 1. It is broken on significant volume. 2. It is broken by 2 successive candles that close beneath it, or 3. An opening gap down exceeds 51% of the breakout range expansion candle that preceded it, and does not raise above the 200 period moving average within the first 30 minutes of trading. As can be seen, NENG went on to violate a number of our key selling signals, and if one utilized these, it would still have profited from the trade. What lies ahead for Network Engines Incorporated is unknown. Only time and the price volume action at key pivot points will tell. Until next week from TradingPennies.com, this is Thomas McClellan, where our goal is to help you learn to become successful trading the penny stock market.